Let's talk about 6 weeks of Fed shutdown. Let's talk about what they are not telling you about that shutdown. Furlough math can fake out jobs reports numbers and move mortgages. First, the big picture. The Fed sets the short-term policy rate to balance 2 goals: stable prices and maximum employment. They watch inflation, jobs, growth, and how tight or loose financial conditions really are. When those signals get noisy, they slow down and verify the trend before making big moves. That is what data dependent means. So what does a shutdown change? 3 things show up really fast. Number 1, growth. A multi-week shutdown usually trims measured GDP in the quarter it happens. Then a lot of activity snaps back after people get paid. Not all of it comes back. In past episodes, independent estimates and the Congressional Budget Office flagged a small but real permanent loss, measured in the low tens of billions. Billions with a B. Translation for us? It is a temporary drag that can make the economy look weaker on paper for a bit. Number 2, jobs data. Furloughed federal workers can be counted as unemployed on temporary layoff in the household survey if they reported no work that referenced week, which can nudge the unemployment rate up for that one report. That doesn't mean those jobs disappeared. It is a classification rule. The last long shutdown made this show up clearly in January 2019 data. Number 3, data flow. Some official economic reports get delayed. That creates a data fog. When the Fed cannot see clearly, it tends to pause or move in smaller steps until the next clean round of reports lands. Now, how does that shape the Fed over the next few meetings? With softer growth on paper, a one-off uptick in unemployment due to classification, and delayed inflation reads, the Fed's reaction function tilts cautiously. Markets right now are pricing decent odds for another small cut by the end of the year, but those odds have been moving with each data headline. I am watching the CME Fed Watch probabilities in the financial press day by day. The message is not guaranteed cuts. It's the bar is higher until the fog lifts. Elephant in the room, mortgage rates. This is the part that my buyers, sellers, and investors actually care about. Mortgage rates are not set directly by the Fed. They mostly track the 10-year Treasury yield, plus a spread that compensates lenders for prepayment and credit risk. When uncertainty is high, that spread can widen, which is why you sometimes see mortgages fall less than you'd expect after a Fed cut, or even rise on a day the Fed eases. As visibility improves, spreads can narrow. I watched a 10-year and the Freddie Mac weekly survey to see this in real time. Here are the 3 near-term scenarios to keep in mind. Scenario 1, the shutdown is over and back pay and contracts restart smoothly. We get a noisy month of data, maybe 2, then clearer reads. In this case, the Fed may either pause to confirm that inflation is still trending lower, or deliver one small cut if labor softening shows up outside of the furlough effects. Mortgage rates could drift lower if the 10-year cools and the spread narrows. Scenario 2, the data comes in weaker than expected after reopening. That could tilt the Fed toward another cut sooner rather than later. The key here is whether weakness shows up beyond government and contractors. If it does, the bond market usually moves first, then mortgages follow. Scenario 3, the data rebound and inflation proves sticky. Then the Fed waits even longer. In that case, mortgage rates could chop around, driven more by the 10-year Treasury than the policy rate itself. So what should you do with this? If you're buying, set 2 action points with me. 1, a rate target where we lock in because that payment works for your budget. 2, a time target so you're not gambling your whole home search on timing the last quarter point. To all my VA buyers out there, remember that your funding fee and entitlement rules matter more to your monthly than the headline rate moving an 1/8 of a point either way. We will model both. Not financial advice, just a disciplined plan. If you're selling, assume buyers will stay payment sensitive. Pricing and presentation matter. The minute rates dip, you will see more showings. Not magic. We will price to the current comp set and lean on prep that widens your buyer pool. If you're investing, Watch the debt service coverage map, not just the headline rate. Cap rates and rent must pencil first. The spread between mortgages and the 10-year have been wider than normal at times, so do not assume a 1-to-1 drop if the Fed cuts again. If you own and are thinking about refinancing, set an alert level for your target payment or break-even months. When we hit it, we act. If we are close, a float with a rate cap from your lender can be a smart hedge. Again, plan first, then execute. I will do my best to keep translating the macro into plain English for Hampton Roads. If you want my weekly 2-minute Fed to mortgage update with local content, reach out and I will make sure you get it. And if you want me to run your numbers under 2 or 3 different rate paths, let me know and I'll get my blender to help you out. I hope this helps you feel clear, calm, and prepared. I'm LJ. When you need a trusted guide in the 7 cities of Hampton Roads, my team is here to help. Are you thinking about listing while buyers stay payment sensitive? Comment sell and your zip code. I will reply with a pricing plan and a prep checklist that widens your buyer pool. Talk to you soon.